7 stocks I'm buying now, March 2023 edition. Welcome in, folks, to my favorite series I do on this channel each and every month. Sometimes it's called 3 stocks I'm buying, sometimes 5 stocks, sometimes 7 stocks, sometimes 11 stocks. You basically know if there's good opportunities in the market based upon how many stocks are featured in this video each and every month. And now we have some real opportunities in this market that have emerged over the past several weeks with kind of some downtrending in the market. So a lot of opportunities out in the market right now. And today I'm going to take you through the 7 stocks that I'm buying this month, and I'm going to take you through kind of the bull thesis on them, kind of speak about them and kind of my opinion on them, income statement wise, balance sheet wise, what's going on for their business models, why I believe the shares are going to appreciate rapidly over this next few years, and those sorts of things. As always, I appreciate every single person that always watches this series. And I know sometimes these videos get seen by people that aren't usual subscribers of the channel as well. Sometimes they just get fed into the algorithm. And so a few things I thought would be relevant to cover up here at the front for people that don't usually watch my channel but get to see these videos. Okay, first thing is, when it comes to these stocks, I'm not chasing the breadcrumbs with these. I'm going after the loaf of bread. So in regards to stocks, right, you can kind of play it 2 ways. One is you can get in and out of stocks, right? A stock can go up 1% and you could sell it, right? And that's certainly a strategy some do. I do a little bit different strategy. I like to add to major positions over a period of time, build those out, and as that company thrives over the coming years, usually their stock price thrives over the coming years, right? And I'm usually looking for undervalued opportunities in the market. I'm not looking to just make 1% and go dip on a stock, okay? Second thing is, all these stocks we're going to go through in today's video fit my strategy of GVD, okay? Meaning growth, value, dividends. And I'll tell you each one of these stocks if they represent a growth stock, a value stock, or a dividend stock for my portfolio. Third thing is, I hope these stock prices go lower short term. Sometimes people are like, well, aren't you worried? Like, you know, the stock price could go lower next week or lower next month or something like that. That doesn't concern me at all. Actually, I welcome that. As somebody that wants to build these positions out to be much more substantial than they already are in my portfolio, I would love these stock prices to go lower in the short term. That doesn't scare me at all, not even 1%, okay? Fourth thing is I always buy regardless of market situations, okay? So regardless if the economy's strong, weak, okay, I'm always a buyer out there in the market. It's just different opportunities I'm looking for in the market. And last thing before we get into these 5 stocks, if you want to learn directly from me on everything I look for in companies, my in-depth process, you know, going through it all, things like that, and learn directly from me, apply to join my private stock group, the private wealth group. That will be in the description area. Might also be the pinned comment down there where you can learn directly from me on exactly how I invest, okay? And then also, if you're looking to have access to see the moves I'm making every single week and the stocks I'm buying every single week, then consider joining the Patreon. That will be in the description area. Every single week I'm making moves in that portfolio, and I show you the exact moves with screenshots every single week in my Fidelity account for the Patreon. So let's get into this, guys. Hope you enjoyed as always, and thank you everybody that subscribed to the channel, okay? First of these 7 stocks that I will be buying in March of 2023 is Amazon. Amazing-zon, okay? Great opportunity in Amazon right now. Now, a lot of people, when they think about buying Amazon stock, they think like they're just getting, I don't know, the e-commerce business, right? When Amazon is so much more than that. You got to understand, you're getting, yes, the e-commerce platform that you probably order stuff on all the time, okay? That's awesome. But you're also getting Amazon Web Services, which is arguably more valuable to Amazon than their e-commerce business. Now let that sink in for a moment. You see all those Amazon trucks driving all around your neighborhood all the time. You're probably placing orders on Amazon all the time, right? And to think this business is more powerful than that business is incredible, but it is actually, okay? And this is their straight profit machine business, Amazon Web Services. They also have an advertising business that is growing very, very rapidly right now. They also own Whole Foods. They own Twitch, which is a streaming service, right? They also, think about it in terms of, this is basically a massive distribution company. Like, who has more warehouses than Amazon across the world, and especially across the United States of America? This is basically the biggest distribution company in the world, right? And also, you're also kind of getting a little mini UPS or FedEx in their business. Like, you know, think about the fleet of trucks they have, the planes this company has now at this point in time. This is basically a transportation company that's building out, and it's very possible that Amazon could be even bigger just on their transportation business than even companies like UPS and FedEx. And this is like, think about how insignificant that business is compared to their other businesses, right? So you've got to understand, you're getting this awesome conglomerate that's just a growing behemoth that is Amazon, okay? Now, in regards to Amazon, this stock hasn't done anything in years, right? 5-year, pull up a 5-year chart of Amazon, it hasn't really done anything, right? And I used to speak down on Amazon a lot back in the day. And so it's an interesting shift that now I'm buying the stock heavy when I used to talk the stock down many, many years ago. And the reason I used to talk the stock down is, to be quite frank, Amazon used to be a very overvalued company many, many years ago, okay? And I made videos about this time and time again. Look at this video, July 11, 2018. And I went into why Amazon and Netflix stocks were overvalued, okay? Amazon's market cap is only slightly above that market cap as of right now, okay? This was just a company, you know, and I'm recording this in March of 2023. This is almost 5 years ago, right? The company at that moment, given what the growth rates were, given where the company was at that day, it was an overvalued company. But I can tell you now that they've caught up with all this growth and the stock price really hasn't done anything, now it's actually a very undervalued company. This is why understanding how to price stocks, why to understand like how to actually value a company is so important. If you don't understand how to value a company, you could have been buying Amazon 5 years ago and still basically have not made any dang money in that stock, right? Versus understanding now it's a tremendous opportunity and likely making a ton of money over this next 5 years, okay? By the way, Netflix, I was right on as far as that one goes. Netflix's market cap as of today, and it's come back tremendously, but I think it's about $140 billion market cap. The stock price is quite a bit lower today than it was actually back in that day. So nonetheless, folks, it's been a whole change in Amazon. They've caught up with their business model now at this point in time, and it's a tremendous buying opportunity. And so with Amazon, I'm looking at a company here with a fortress balance sheet, growth as far as the eye can see with this business model, a forward P in the 40s, which is way too low in my opinion, okay, way too low. And their major net income ramp over this next 5 years. I think their net income is going to ramp much more substantially than their revenue for this company. So I love Amazon. It's absolutely a stock I'm buying. Anything under $100 a share, gimme, gimme, gimme. If we're talking anything in the 80s, 90s, that's even a better situation for me. So yeah, great company. Just buy, throw in the filing cabinet and call it a day, okay? Stock number 2 of these 7 stocks up here is Palantir, PLTR, okay? Palantir, you know, it's somewhat of a known stock in the retail community, but not a widely known stock from folks maybe outside the retail community. But this is in my opinion, one of the most direct plays on artificial intelligence I think out there, to be quite frank. And I know everybody's really excited about AI and the potential there, and it does have tremendous. But if I think about Palantir, they've been working on this for many, many years, okay? You know, when it comes to Palantir, this is a company that's at the cross sections of data and artificial intelligence in helping you as a government, okay, maybe it's a military, or helping you as a business make better decisions with your data. Not just hold your data and it's like, here's a place to put all your data in the cloud or something like that. It's a place to decipher that data and help you make better decisions. Hey, you need to do this. You need to order this. You need to do this, okay? You know, and this has been something that in the early days obviously was massive with the government, but now they're starting to build out big B2B, okay, in terms of helping companies basically use Palantir and help them save a lot more money or make a lot more money. And so in my opinion, every Fortune 500 company out there is going to have to at least consider using Palantir, and their contracts are big for Palantir, okay? And they have 3 main products, Foundry, Gotham, and Apollo, and you'll hear about those products a lot over time if you are a Palantir shareholder with this company, okay? Now, for this company, it's actually not expensive. It might look expensive at face value at something like, let's say, a 40, 42 forward P or whatever, right? But I can tell you, this company just started to hit profitability, like literally just started, okay? And so this is extremely early days for Palantir in regards to what their profit potential, their net income potential is over the next 5-10 years. This is like baby steps in this game now at this point in time. So although it looks expensive because the market trades at forward P of, let's say, 18, 20, something like that, I can tell you this is not expensive for a company that literally is just getting to profitability now at this point in time, okay? And so when it comes to a company like Palantir, I'm looking at a company that's at a market cap of, let's say, $16 billion or so, right? The share dilution is much less of an issue than it was in the past, and so that's great for the company. $2 billion plus in cash on their balance sheet, debt-free, right? They're in the first innings of profitability, literally the first inning, okay? This is just starting. As far as revenue growth goes, this company should be able to put up anywhere between 15% and 25% revenue growth per year. And I wouldn't be surprised if this company starts to knock out profitable quarter after profitable quarter. I wouldn't be surprised if they do a share buyback in 2024 or 2025, especially with all the share dilution they had, obviously, in 2020, 2021. I wouldn't be surprised if they end up buying a bunch of shares back, which obviously helps us all out as shareholders. And so Palantir, a tremendous opportunity in my personal opinion. It's why it's a stock I'm buying now at this day and age. Like, so early days with this one in regards to what their long-term growth opportunity here is. Oh my gosh, okay? So absolutely love Palantir. Next one up here, number 3 of 7, Texas Roadhouse. So those first 2 stocks, they represented growth stocks. Amazon, Palantir, both of those were growth stocks. Texas Roadhouse represents a dividend stock for me, okay? Now, Texas Roadhouse. They're arguably the most well-run restaurant chain, which, by the way, I don't know if I quite spelled restaurant there. I think I might have forgotten an S in there, okay? The most well-run restaurant chain in the United States of America, in my personal opinion. And not by a small amount. I think they're the most well-run by quite a bit, okay? They own Texas Roadhouse and Bubba's 33. Bubba's 33 is still very early days with their growth. They have a very small amount of locations compared to Texas Roadhouse. So this is a tremendous opportunity. And, you know, if you've ever been to Texas Roadhouse, like, I've never seen anybody go to Texas Roadhouse or taken somebody to Texas Roadhouse and they didn't enjoy themselves. Like, it's always great food, extremely fair prices, and super high quality for the price point you're at. Like, it doesn't get better than that, okay? Always good staff, good customer service. It's just always a phenomenal experience. They have way more locations coming. Texas Roadhouse alone, like just in my city, Vegas, I'm like, there's so many opportunities for more Roadhouse. I got a house in Phoenix, right? Phoenix, Arizona. I'm like, there's so many more opportunities for Texas Roadhouse. Like, I can tell you every state out there has way more opportunity for more Texas Roadhouses to do crazy volume, okay? And so they got way more locations coming over this next 5 to 10 years. Comp store sales are booming for this company. If you look at their last quarterly numbers, it's ridiculous. They're growing comp store sales in a tremendous way right now. The company's a money printer, which is crazy because their food it's available to the masses, right? Like, their food is affordable. It doesn't matter, like, you know, pretty much if you're in the middle class, you can afford it. If you're maybe a little under the middle class, you can afford it. It's like anybody can kind of go to the Texas Roadhouse and have a great experience because most of their dishes there are between $10 and $20. It's not like many restaurant chains that are kind of, you know, $20, $30, $40, $50, $60 for entrees. This one's affordable to the masses, but yet the company is so perfectly well run. They're so efficient with everything they do that it's a money printer. And sometimes you'll go there, and I go there myself, and I'm like, dude, how do they make money? Like literally, you go there and you pay like $13 and you get like a full-on like great salad, you get a tremendous entree, plus you get a side, plus they serve you these delicious biscuits as you go in that are just tremendous with this like cinnamon butter sauce, and you're just like, how do they make money? Like, literally, how do they make money? But they're so perfectly efficient that they're actually a money printer despite having like just incredible pricing that's available to like everybody out there, right? So nonetheless, they can do well in almost any type of economy, right? They're nearly debt-free on the balance sheet now at this point in time. Nearly debt-free. They're talking about paying off the debt within the next few quarters here, essentially, to basically have no debt on their balance sheet at all. That's amazing, right? There aren't many restaurant chains that have no debt on their balance sheet, I can tell you that much, okay? And especially in a higher interest rate environment, you don't really want debt right now. They have a share buyback on right now, so they're taking shares off the market, which is going to help out all us shareholders in a tremendous way. And they have a nice dividend yield of 2+%. And in my opinion, they're going to increase that dividend rapidly over the next few years. So the amount of dividend money I'm going to get paid in my first year or two owning this stock is going to be a very small amount of money, in my personal opinion, versus the dividend money I'll be getting paid out 5 years from now, 10 years from now in regards to this one, okay? Remember, this was a $5 stock in fall of 2008. It has been one of the most incredible, like just running a business model to perfection they've done over the last number of years here in regards to Texas Roadhouse. Absolutely beautiful. Forward P is in the 18 to 22 range for this one, and I get to sleep very well at night. Like, that's awesome, okay? Now, dude, keep in mind, Texas Roadhouse announced a cash dividend of 55 cents for each share you own. The ex-date is March 7th in regards to that one, okay? Now, like I said, dividend yield 2+% right now. That's a small number from the dividend they'll be paying me in the future. So at this PE, that dividend yield, owning this quality of a stock, which is one of the most quality stocks in the entire stock market in any industry, and I get to sleep well at night, I'm like, okay, that's a pretty good opportunity, okay? Now, this is not a stock I'm personally buying at the moment, but I might consider, and this is a stock I owned in the past, Cheesecake Factory. I just wanted to draw this to people's attention. It's trading far cheaper than Texas Roadhouse right now, so it might be an opportunity there. Also has a bigger dividend yield. It is not as high quality as Texas Roadhouse, so do keep that in mind. It's not as well run. It's still a very, very good company, but there's levels to this game, okay? There's levels to this game, but nonetheless, I think Cheesecake Factory is an opportunity. It could be one I end up making a move on at some point in time, okay? Next stock up here, number 407. What is it? It is WBA. This is another dividend stock for me here. This is a simple one, okay? Very, very simple. Dirt cheap valuation, which, by the way, if you don't know Walgreens, you must not live in the United States of America, because there's just about a Walgreens on every other corner, okay? Dirt cheap valuation on this company. This is a year 2 of Roz Brewer being the CEO of this company. Now, do you know where she worked before she worked at Walgreens? She worked extremely high up at Amazon. She worked extremely high up at Starbucks, okay? And if you're talking about the type of companies you want to get experience at being a high-level executive, I think Starbucks and Amazon are some pretty good companies to have worked for, okay? And I believe she probably learned a lot over the last couple decades working for those type of companies, and she's going to take those into Walgreens, and I've already seen her change a lot for this business model, and I think a lot of those dividends in terms of the work she's been putting in is really going to pay off in a significant way over this next several years. Now at this point in time, year 1, you're just trying to get your footing and try to get the business in a position to thrive over the coming years, and I believe we'll start to pay out those dividends over this next few years in regards to Roz Brewer over here, okay? The balance sheet, she's had a major balance sheet cleanup at the company, and basically just getting the balance sheet into a stronger position, selling off some other assets that weren't core to the business, right? It's a more focused business now than it was in the past, where it was kind of like all over the place. You're like, what is this? They're really going into becoming a healthcare just related company now at this point in time, which I absolutely love, okay? Huge dividend yield on this one. Absolutely insane. It's a needs-based business model that's not going away, right? And unfortunately, you know, the baby boomer generation is aging, right? And we do know when folks are aging, they're much more likely to need, pharmacy-related products. That's the bottom line, okay? And obviously, Walgreens will be one of just many big beneficiaries of that. CVS will be a beneficiary of that, right? I think Amazon will even be a beneficiary of that as well. So, as sad as it is, the baby boomer generation is getting older, okay, and I know it's a lot of our parents out there, but yeah, nonetheless, Walgreens is in a really, really strong position across the board here, okay? And if you look at their guidance, look at this here, okay? They're maintaining their full-year adjusted EPS guidance, 445 to 465. They're raising their full-year guidance, raising full-year sales guidance to 133 billion to 137.5 billion, reflecting the Summit Health acquisition for the company. And so this company's in a very, very strong position. Increased clarity into the company's long-term growth algorithm, building to low teens adjusted EPS growth in fiscal year 2025 and beyond. So the company's just in a really, in my opinion, improving spot over the next few years. And they went through a lot. It was kind of an unfocused business model that was all over the place. But now I believe they're going to be on a great path. Okay, the forward P on this company's under 10. Under 10 for a forward P, that's as dirt cheap as you can pretty much get in the market, right? Dividend yield of 5+% on this one. So, let me get this right. A huge improved balance sheet. They got in my opinion, a very impressive CEO that's going into year 2 at this point in time, getting it for a dirt cheap valuation, getting a huge dividend yield, and they're very focused on healthcare, which is very needs-based. Yeah, count me in. Okay, I'll take advantage of that and collect that nice dividend money, and I'll likely get nice share appreciation on the stock over the next few years as well, okay? But let me be clear, it really serves as that dividend stock. And the more profitable the company can hopefully become over this next 5-10 years, the bigger the dividends are. So think about it. I'm getting a 5% plus yield on the shares I'm buying right now, right? But if they keep up in that dividend, then based upon the shares I'm buying, I could end up turning into a 6% yield, 7% yield. In a few years, who knows, maybe it's a 10% yield that I'm getting on my shares that I bought, right? That's tremendous, okay? So yes, Walgreens, very excited about that one. Next stock up here. What are we at? We're going into number 5 here now at this point in time. I believe it's 5. Yes, it is 5, okay? This one represents growth. It is RVLV Revolve. This is a clothing e-commerce company. Now, the interesting thing is, this is a growth stock trading at a value pricing, okay? Look at their forward P and tell me that's not like more like a value stock. Yes, it's trading like it's a value stock right now, but yet it's a growth company. And when you can get a growth company trading at a value stock type pricing for forward P, that's when you got a real huge opportunity on your hands, okay? And so I love RVLV. It's done me tremendous in the past. And I think I'm back to buying the stock because it's just an insane opportunity here. It's a clothing company of Gen Z and millennials, especially for obviously females specifically. That's their main customer base. And, you know, through their Revolve platform and their Forward platform, they're just great at attracting a lot of the Gen Zs and millennials. And I just think they're going to build out to be this tremendously huge company over time as they get more and more loyalty with that generation. They have growth as long as the eye can see. I mean, just like, you know, I don't know when Revolve stops growing, but I can tell you it's a long time in the future, right? They have very impressive margins and profitability at this company. I think they're going to get, you know, 2022 was kind of an off year for them. 2023 and 2024, I think you're going to see tremendous growth in margins and profitability. They have a great balance sheet in this company, top tier executive team for a smaller company. These guys have done such a tremendous job running this company. It's insane, okay? 10 to 20% top line and bottom line growth per year for the next 5 years, in my opinion, for Revolve. You know, if you look at what analysts are expecting, they're expecting next year a huge ramp up in earnings per share, and then they're expecting a huge ramp up in revenue growth for this company. But in terms of my numbers, I have them growing 10 to 20% top line and bottom line per year for at least the next 5 years, if not much longer than that. And so Revolve, really tremendous opportunity here. You look at the balance sheet, right? Cash is booming. I mean, there's a market cap of what? Less than $2 billion roughly on this company. $234 million just in cash and cash equivalents sitting on their balance sheet. Oh my gosh. As far as total assets go, $597 million in total assets versus $199 million in total liabilities. Phenomenal. Phenomenal balance sheet. They could do a lot of things with that cash. If they want to do a big share buyback, they could do that. Like you know, if they want to just keep it there for a rainy day, they can do that. I mean, just a company that's so well run, such a great balance sheet, such a great income statement and opportunity for this company over the next 5 years. It's ridiculous. So love RVLV. It serves as a growth stock for my portfolio. Number 6 of these 7 stocks up here is Shopify. Shop stock, number 6 of 7. Shopify is Amazon before 2010, okay? Prior to 2010, a lot of people weren't sure about Amazon in regards to what their profitability would be. No one was even talking about Amazon Web Services back then. Although Amazon Web Services existed, no one was really talking about it. And what I see in Shopify is I see a very misunderstood stock right now, where very similar to Amazon prior to 2010, everybody was looking at it and they're like, this kind of seems like it's the future. They got this huge revenue growth opportunity, but we're not really sure what the profitability will be and those sorts of things, okay? And I just say, you know, let the story kind of play out here because it's a tremendous story in regards to this one. 15 to 25% revenue growth a year as far as the eye can see, in my personal opinion. Could they eclipse those numbers? Certainly it's a possibility. I might be a little more conservative with my shop numbers, and I'd rather be a little more conservative than too aggressive with this, okay? They're going to be silly profitable long term, and I mean silly profitable. Much better net income margin than Amazon. So, you know, when you look at Amazon's revenue and how much it actually makes it down to the bottom line, it's a very small number, and I think that number will improve, by the way, for Amazon substantially over this next 5 years. But nonetheless, like Shopify can make a fraction of the revenue and, you know, have that bottom line increase much more substantially over time. I think they're going to build into one of the most profitable companies in the world over this decade. Their balance sheet is pristine. I love that as a Canadian company. Like, obviously I live in the United States. I've never even been to Canada. I just appreciate that, like, you know, there's a Canadian company that's going to build into likely a giant tech company. Because, I mean, let's be honest. I mean, almost all the giant tech companies are in the United States, right? And so it's just cool to see like a future massive tech giant. And you could make an argument that it's already getting there, right? $50 billion market cap, but long way to go. In order to be respected as a tech giant nowadays, you really need like a $500+ billion market cap, if not $100 billion plus, if not $1 trillion market cap. And I believe that is where Shopify is going long term. And their crazy comps that they had to comp against year over year are now done at this point in time, right? The 2020, 2021 comps, those are over. Now they're going to be comping against 2022 numbers, right? And you look at some of the numbers for this company, right? Think about this. Their revenue in 2022 was up 21% to $5.6 billion. That was a bad year for Shopify. A bad year in your revenue growth was 21%. Like, how many companies could have a bad year and have 21% revenue growth? Incredible. $650 billion in global commerce since Shopify's inception. They have about a 10% U.S. e-commerce market share, and they expect further penetration. Yes, that will likely play out. 561 million unique online shoppers purchasing from Shopify merchants in 2022, and they have millions of merchants in 175 countries. So keep in mind, when it comes to Shopify, this is not just a story around United States or Canada or something like that. This is a worldwide opportunity for Shopify. Shopify point of sale is becoming very, very much more popular now at this point in time. 40% 2022 offline GMV year-over-year growth for Shopify point of sale. Shopify Pay becoming much more popular. That's just a crazy opportunity. Look at this. Just in Q4 2022, gross merchandising volume of $11 billion through Shop Pay alone. The Shop app, if you want to talk about, I don't want to say like Shopify is necessarily a huge competitive threat over time to Amazon, but I wouldn't be surprised if it doesn't emerge as more of a direct, competition for Amazon longer term, right? And Amazon's tried many times to try to replicate Shopify's business model, and it hasn't been able to do it. But I also see Shopify trying to go a little more Amazon route in basically creating the Shop app, where it's an app where you kind of go like you do on the, Amazon. You might have the Amazon app on your phone or your iPad or your, wherever, right? And, you go there and you kind of search stuff and you go find stuff to buy, right? I mean, the more I look at it, the more I'm like, I think Shop could be potentially a competitive threat to that over time. I think Amazon's going to continue to be Amazon, but I got to say, this is just a tremendous extra opportunity for Shopify here that I don't even think anybody's even looking at right now, to be quite frank. Kind of like a lot of people missed Amazon Web Services, and they were just focused on the e-commerce business, and they totally missed that. I think people are missing that Shop app completely right now, okay? Shopify Capital is growing rapidly right now for this company, $4.7 billion in 2022. Shopify Tax is another product that's taking off. You see all these products, and basically what Shopify wants to do is, if you're an e-commerce, if you're somebody that's looking to get into e-commerce, right? Or maybe you already have a commerce. They want to be the easiest way to do it, the most efficient way to do it. They want to be your everything and just one place, get it all done for a very fair price, and actually much more fair than if you had everything across the board. I think it's a very smart strategy, and they're executing on a very high level. And it's a very similar strategy to kind of how Microsoft, if you know anything about how Microsoft runs their business, right? Microsoft's kind of like your everything. They run your everything, right? It seems like it, at least in terms of their suite of products. They want to have this, they want to have this. And so next thing you know, you kind of got a little bit of everything there, right? And so it looks like Shopify wants to go that route, but I wouldn't be surprised if Shopify just does a little better job in terms of their business and kind of, how everything works. I always hear complaints about, some Microsoft stuff, and Microsoft has kind of just always been that company that just wants to copy, right? Tremendous company, and they've done amazing, but I wouldn't be surprised if Shopify just does it on a higher level than, kind of anybody else out there. So I love this, man. I absolutely love this, right? Check out the growth recently. 26% growth in Q4 of this year versus 21, right? 28% on a constant currency basis. Remember, this was supposed to be a bad year for them, and they just had a Q4 with 28% growth on a constant currency basis. On a bad year, what's their growth look like on a good year? That's why when I talk about 15 to 25% growth, I might honestly be way too conservative, to be quite frank, okay? Merchant Solutions, 30% growth year over year, but check out subscriptions solutions, only 14%, but they're going up on subscriptions for the first time in almost a company's history, okay? And so expect this number to grow substantially over this next year, okay? Substantially. So look at this. I mean, we're talking about, once again, this is a bad year for the company. Around $800 million of gross profit on a bad year? On a bad year? Oh my gosh, okay? Imagine where the gross profit's going to be a decade from now, 5 years from now. I mean, my gosh. And look at their balance sheet. Total assets, almost $11 billion. Total liabilities, 1.6, right? And you look at cash and cash equivalents along with marketable securities, you're over $5 billion just sitting there. I mean, talk about a great balance sheet. So when I look at Shopify here, I see a company that, oh my gosh, I just absolutely love in the biggest way. And this is a position that I want to build out much more substantially this year, because I'm telling you, these sorts of game-changing companies, like, when you think about who could be the next in the $1 trillion boys club, right? And you think about what's the next generation of stocks to get there over this next decade, right? The future Amazons and the future, Teslas and Apples and Microsofts and Google McDougals, right? And all those sorts of companies. And I'm looking at Shopify and I see that company. I see that company that can grow into that sort of company, that they're producing tens of billions of dollars of net income year in and year out. And just a crazy opportunity. I mean, like I said, there was a bad year, and they just had 28% revenue growth on a constant currency basis in the last quarter, year over year, on a bad year, man. I mean, what's it going to look like on a good year? Insane opportunity, okay? Next up here, before we get to stock number 7, I want to mention 2 stocks that we'll call them honorable mentions, okay? They're honorable mentions. These 2 companies aren't profitable yet. That's why they can't be on the list. Okay, there are 2 stocks I own, and I'm hoping I can put them on the list, hopefully in the future, but they can't get on today, so that's why they're only honorable mentions. One is Avant. This is the smallest company I own personally, and they just reported their earnings. 219% revenue growth. I don't know if you'll find a faster growth company in the world than Avant right now. As far as adjusted EBITDA, 1.6 million is 208% growth. Record cash flow from operations, 1.6 million is 229% growth year over year. But the company still has a net loss on the company. So that's why it can't be on here. It's unfortunate. I wish it could. Hopefully they'll fix that net loss and get it to a net income here in the very short term, because I'm looking at the growth and I'm like, I think you guys should start posting some net income here, and I hope they get. I mean, shoot, if this company can just start throwing off a few $1 million a year in net income, it doesn't even have to be a big number because the market cap's so small. A few $1 million a year is like a game changer for that company and what the valuation would have to go to, and also if. Yeah, they could pay out some crazy dividends if they wanted to on just a few $1 million of net income a year. So, yeah, I'm hoping this one could be on the list in the future and not just an honorable mention. On a same exact situation, you know, they got to get to net income positive at least a couple quarters in 2023 to get back on the list. Again, it is a stock I own a bunch of shares in when I was buying my unprofitable phase. You know, and I'm very confident they're going to get there, but they're not there today. And so they just have to be an honorable mention. They can't actually be on the list, okay? Get it together, honest. Get that bottom line together, baby. You and Avant, and you guys can be on this big dog as well, okay? Number 7 of 7, last stock up here, is Foot Locker. This one serves as a dividend stock. By the way, Shopify, if you didn't know, served as a growth stock. I'm pretty sure everybody knows that, okay? This one serves the purpose of a dividend stock. The interesting thing about Foot Locker is it's kind of needs and wants based, since they sell, you know, they sell clothing and they sell shoes, right? It's kind of needs and it's wants based, because you go there if you need shoes, but also there's a lot of people that buy some higher end shoes from Foot Locker that are more almost in the wants base as well. Dirt cheap valuation on this company. Huge dividend yield on this one. I mean, you know, recently the dividend yield was around 4% on this company, somewhere around there roughly. Very good balance sheet on this company. It's a cash flow beast for Foot Locker. And so this is one of those companies I look and I just love to hold it. It throws me off all that dividend cash flow. I believe I'll get nice share appreciation. I don't think it's going to be a huge number over time. I think I'll get slight share appreciation every year, right? And it doesn't work perfect like that, right? In terms of stock goes up every year, but over time I should get nice share appreciation. And like I said, just collect that dividend money, throw it into other dividend stocks. Maybe it's more Foot Locker shares or it's other stocks, and just kind of continue to build the portfolios out over time. If you want to see the moves I'm making every single week, check out the Patreon down there. That'll be to access my Fidelity account in there for the Patreon portfolio and see the moves I'm making every single week with screenshots. I share it with everybody in the Patreon. Also, if you want to learn directly from me and learn everything I know up here and everything I learned about the money game in the past 15 years, and you want to join us and apply to join us in the private stock group and my private wealth group, check out the description area. That will be to apply for joining us in there. It might also be the pinned comment down there. Thanks so much for watching. Thanks for being subscribed, and have a great day.